Hello and welcome. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. Well, the markets continue to remain on the weaker footing. In fact, as we speak, we're talking about another 1% coming in on the downside. Broader markets too are weak. Well, the China issue is not really flaring up big time, but it is triggering some amount of profit taking across the board. And there was a lot of profit to be taken from the market or from the table. So it's just providing in a trigger for that. Adani Group stocks have perked up. There is news coming in that NSDL has actually rectified or changed the stance of the FPIs who were invested. Remember, there were some news reports coming in of the accounts being frozen, but actually it is a different matter. Let's talk about markets and how we have some amount of trigger from China and overvaluation in some pockets of the market triggering profit taking. Nimesh Chandan is here with us. Nimesh, how are you analyzing the overall scenario, and what's the hypothesis you're making and approaching markets as?
Hi Ajay, always nice to be on your show. So in my interactions with some of the investors and financial advisors, there are a few signs of worry or that they are bothered about. But frankly, like Paul Samuelson said, that markets tend to be over-worried, and they have predicted 9 out of the last 5 recessions. So I believe that while investors getting a bit worried is good because it prepares them for the future and they don't throw caution to the wind. But at the same time, you should be worried about the right things. So the few things that I gathered about what people are worried, the China thing is a bit new, but I don't think it's a big importance for the Indian market. People are looking for a correction, so that can possibly trigger one. But the 4 things that I found people discussing quite a bit was one, third wave. A lot of people were trying to predict that. The second one was the increase in interest rates and whether central bank liquidity that the global markets are enjoying, whether that will go away. The third was about market valuation. I think you spoke about that in your introduction. And the fourth is, when the correction comes and how do I benefit from that? Now, I feel that all 4 of them are somehow the expectations are misplaced. Now, let's take, for example, the third wave. It's very difficult to prepare for such a thing. For the first wave to the second wave, people are not able to predict the intensity or the timing of that wave. But at least we had comfort that businesses handled the second wave much better than the first one. The vaccination program is going good. We have about now 45 crore vaccination doses delivered. And I think that even if the third wave was to come, I think businesses will handle it better. However, because we can't really predict the intensity and the timing of it, it's very difficult to prepare. One will have to look at asset allocation to really take advantage of that rather than worry about it too much. The second is the inflation and the interest rates that people are worried about. While the central banks believe that the inflation is transitory, and I'm in that camp too. In the last 3 months, you've seen only crude oil and coffee as the significant commodities that have moved up. Otherwise, most of them are quite flattish. And even if, say, central banks decide to increase interest rates, their goal is to get the economies on a sustainable growth path. So now if the central banks are increasing interest rate, that means we are on that sustainable growth path and they are confident about the economic growth. I think that should be cheered by long-term investors rather than worried. And of course, corrections are part of a bull market, so they can come anytime. We can't really predict it exactly how and when, so we'll have to use that rather than worry about it. And market valuations, well, if you see the markets pre-COVID were at, Nifty was around 12,500 and right now we are at 16,000. So it's about a 30% move. Within that, in the last 1.5 years, earnings have moved up by about 15% in Nifty. So half of it is justified by earnings movement, half of it is re-rating. And considering that the economy is on a recovery path and expectations of Nifty earnings of 30% in this year and 16% growth in next year, I think that re-rating is justified to that extent. Also, the market is at about 19 times FY23 numbers. Now, how do you really compare it to the previous decade? I mean, you can look at 20-year averages, but the businesses that were listed and in the index at that time were very different from what we are seeing now. So it is very difficult to look at the index valuation and start comparing whether the market is really expensive or it is cheap and where it should exactly be trading. So that's my take on some of the worries that investors have.
Sure. Nimesh, how are you approaching the broader markets right now? Can you share with us the areas you are researching where there are triggers of earnings growth and perhaps valuation is still looking relatively attractive?
One of the important areas or themes that I believe have where the growth is underappreciated and valuations deserve a re-rating is actually on the capex side of the economy. And a lot of people don't believe it because in the last 5 years, yes, there have been so many false dawns in that sector. And there has not been a sustainable pickup, which is why people are worried that this too will be just a few green shoots and then it will perish. But I believe this time we are embarked on a much better capex journey, and it is funded also very well. So government is actually increasing its capex on the infrastructure side, and they've already taken a leeway on fiscal deficit till FY26. On the manufacturing side, the corporates are spending, and the capacity utilizations have moved up, especially for the large players in the market. And there are incentives on tax benefits which are given by the government. And I'm not talking about just in the budget, but if you take everything from FY19, August 19 to now, there have been a lot of tax incentives to manufacturing setup, to Atmanirbhar Bharat. I think those are helping India do well, and at a time when the world is looking for India as a good sourcing partner. And the third is, I believe, after a long time, we'll see a good real estate cycle where households will increase their capex towards real estate. If you take these things together, infrastructure, manufacturing, and real estate, the number of sub-industries and sectors they benefit is huge. It can lead to a much bigger multiplier effect on the economy. And that's where, compared to the previous cycle, say we had this cycle between 2003 and 2007, compared to that cycle, corporate balance sheets are much better. Today, a lot of these construction companies have either reduced debt or sold off some of their assets to really get their balance sheets in shape. The order books of these companies are in a much better position. They have a visibility of 3 to 4 years. And it is not a cutthroat competition where you cut your margins to get business. I think there is adequate business for everyone. There has also been a certain consolidation over the years. A lot of weak players have left the market. And I think this is what is benefiting the existing players. So, and this is where, because investors have not had a good experience with this sector for the last 10, 12 years, expectations are low, which is where the valuations are also low.
Right. Nimesh, let's break it down. Let's talk about real estate and infra. You're right. I mean, broken balance sheets and and not great quality kind of promoters were a big issue here. But there seemed to be a big change of heart. Promoters beyond the top 5 are also putting in a lot of effort in turning around balance sheets, improve their practices and all of that. Of course, RERA also put a play. But are the earnings likely to come back? Are projects taking off in terms of volumes? Similarly, in infra, do you see cash flows improving going forward?
So absolutely. I think after a long time, we are seeing a much better order to book sales ratio or book to bill ratio for these companies. And for the significant players in the market, they are all talking about controlling their working capital, focusing on cash flows, not aggressively bidding for certain projects where they don't make money just to show order books. And in fact, the way the investors have also looked at infrastructure in the past and now is different. I mean, earlier we were giving valuations to just getting more, securing more orders or getting more BOT projects, that is build, operate and transfer projects, which were asset heavy for these companies. And right now, what we are seeing is a completely different side. Investors are looking at cash flow. They want good returns, return ratios for these companies. So managements have also aligned to these. And as I said, as the sector has gone through a certain cleansing, certain excess capacity is gone. In the last 5 years, there have been so many changes in the economy which have affected large sectors. And which is why I say the cleanup of the banking sector, the GST implementation, the demonetization, and the pandemic recently. So these have actually pushed people to clean their balance sheets, clean their act, And now those companies which have good balance sheets are able to take orders. That ensures a certain type of visibility in their earnings and in their cash flows, and hence it is better to give them a higher multiple, though it is among the few companies in the sector. You see, let's take technology sector. The last I think I saw technology sector getting high multiples of 60 and 70 times was actually in the early 2000s, right? Right now, as technology sector starts delivering visibility and growth, the valuations have come back. The same thing will happen on the infrastructure side. Now, whether you take a capital goods company which is supplying equipment, or you take a construction company, each based on its merit will deserve and get a higher re-rating on that.